Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined today by Mr. Mike McGlone, Bloomberg Intelligence commodity strategist based in the East Coast of the U.S., sometimes in New York, sometimes in Florida. Mike, good morning, good afternoon.
Well, good morning, Sean. I'm actually moved to Miami, so I'm in Miami now.
Okay, Miami. Good morning then. Nice sunny, a bit like ourselves here in Dubai.
Yeah.
So my dramatic events on Friday, waking up on Monday morning, the sort of the night, the morning after the night before. Is this a crash we saw on Friday or a normal reversion to the average trend line?
Yeah, I like how you led off with that, Sean. The answer is yes, because it's both. But it's the key thing about what happens when markets get too distorted from long-term means. When they revert to those means, it can be considered a crash. So let's give you one example. The 1987 stock market crash in the U.S., the S&P 500 ended up 2% on the year. If you didn't know it crashed in between, you would say, it doesn't mean anything. That's to me what's happened in crude oil. Now, yes, we're getting the bounce today, but I think it's just indicative the prices should continue to go down a lot easier than they go up. So remember on July 19th, prices dropped about 10%. They've come back, but we're so far above the U.S. and Canadian oil sands cost of production now, and you can see that from the profits that this is unsustainable to keep prices here if history is a guide. And then I just follow the trends of the last 10 years. What has been the key driver of lower oil prices? The U.S. shifting from a net importer, the largest on the planet, to a net exporter. And all my data show next year the problem is going to be the much more to export because of higher prices.
If we take the sort of the crash on Friday, the collapse based on the threat of a resurgent COVID, but it clearly demonstrated that there's some fragility in this market, not only oil, but all financial assets seem to take a big dive, and everybody was dumping as much as they could. Clearly, that's not the sign of a healthy market. One rumor about one COVID strain, and the world nearly collapses.
Check mark. Exactly my key point is now we have essentially an unstoppable rally in virtually all financial assets since the swoon. We said U.S. money supply increase of around 40%. The significance of that, a few assets have outperformed U.S. money supply increase. The stock market has. Crude oil is way underperformed the increase in U.S. money supply. That means that amount of dollars chasing that asset shows a divergent bear market. So I look at it as this, it gave us a little warning sign for next year. And I see crude oil gravitating towards 50, maybe below in WTI. And it basically has to have a higher stock market to just sustain these prices. If it just gets a little wobble, maybe the stock market's up only 5% instead of the 20% or so this year. And God help us if it declines. It shows us the preeminent deflationary trends that were in place before COVID that we've forgotten about, and we've had some major distortions because of this shift, major aberration in human history, and we're going to go back to that next year is what I see in all commodities. Look at lumber. It was up 120% in the year. Now it's unchanged. Soybeans were up 30% in the year. Now they're down. And to me, that's what happens is elasticity supply that kicks in. And the key problem with crude oil is in this country, we just use less of it. It costs less for us to produce it. And, it's being EV'd away.
Well, Mike, if you take the point that WTI is trading at its greatest distance above the cost of production since 2014, according to your most recent note, why are we not seeing more oil production coming out of the U.S.? Are these major oil companies being negligent to their shareholders?
Well, you're absolutely right there, because first of all, they're seeing profits, but the majors are not really increasing production so much. But I always look at it in the oil patch. There's hundreds of oil companies, a lot of them independent. And I, as an farm owner, when you have land and you have an asset below that land that can make you a lot of money, it's just normal human nature to convert it to money. And that's just going to be a matter of time. It's lagging though. So it's just the lagging factor. It's going to happen. So I look at like EIA estimates showing that one of my favorite metrics is U.S. net imports. It was 10 million barrels a day 10 years ago, and now it's going to be probably negative or total net exports of 1 to 2 million barrels a day by this time next year, because we have to pick in that key thing. And the key picture is flat demand. That was only efficiency. So there's the macro, and then there's the micro. I look at the markets We had the steepest 1-year backwardation in about 20 years. That's a horrible sign in commodities. It typically is. When you have that steep backwardation, it means markets are typically have a gravitation towards that, where that price was in the 1-year curve, and it shows producers selling. So to me, technical, fundamental, I don't see much upside. And the thing I worry about is that you need some kind of major supply reduction that, we always seen. It was kind of impressive where President Trump kind of bought the low and President Biden kind of sold the high in SPR. That's very rare, Sean. Have you ever seen that? I mean, it just doesn't happen.
We have oil traders in the White House. This crash on Friday happened in the midst of sort of two aspects that I wanted to look at. One is it happened in the context of the idea of the tapering, the monetary policy going into a tightening cycle, and also obviously OPEC managing the market. Let's take the central bank, the Fed. There was a lot of reporting last week of comments from Fed members indicating, I might be willing to accelerate the tapering process. I'm wondering, does this event recalibrate the market's expectation of the Fed?
Oh, sure. Well, my first point is sustained tightening is a dream, and that's not a opinion. It's more of a fact following trends of easing for the last 20, 30 years. Every time we have a little plunge in the stock market, the Fed goes right back to adding liquidity. So that's what the Fed's navigating right now, pulling back that liquidity, help sustaining the recovery, and then trying to taper, basically try to prick the bubble a little bit. It's clearly a bubble. You just can't go up straight in asset prices without some reversion, yet we have. So I look at it as it's a dream that we'll see sustained tightening, and I would love to see like one tightening, because that'll be a good indication to buy gold if the last tightening was an indication, because gold bottomed literally within the day of the Fed's first tightening in December 2015. So to me, it's a dream. What we should expect in the future is some normalization in stock market returns. God help us if we get a 10% correction and it stays down, then all tightening's off the board. Back to deflation. And that to me is the greater risk. We go back to deflation, and that's what crude oil is telling me. And that's what most commodities are telling me, because humans can produce more of it at a lower cost, and it's just happening, it's accelerating. And I really see that, Sean, being a former farm owner. I might have still very good connections in the Corn Belt. And the technology out there is amazing. That's why the price of corn is basically the same price as it was 15 years ago, and crude oil is the same.
The reappointment of Jay Powell last week, just before all of this drama, not that he caused it or anything, but nonetheless, his reappointment, and with this moment, does the Fed, he's, I would say, on the dovish end of this tightening process. Does he hold back the reins, or will others return to the idea of accelerated taper?
Well, part of Powell's renomination to me, or reinstitution, is part of the lose-lose of commodities. It's the dollar. What was the first reaction? Consistency. The dollar went back to strength. The dollar's been going up virtually a basket of commodities forever, basically. Our data basis goes back 50 years. It's had a recent correction, most notably for the last 10 years, and it still has the upward bias. So that's not good for overall commodities priced in dollars. So there we go. And then I look at what's happened with Powell is he's indifferent. I don't think in the big picture the Fed chairman makes a big difference unless they're a political pawn. And that's where I give Mr. Powell kudos for profiles and courage. He stood up to President Trump, who wanted rates to be zero, and said, no, we're independent. He did later when the data provided it. But to me, he deserved that renomination because he kept the democratic values of this check and balances in this country that really, it supports the value of the currency. But it's also those check and balances that are major pressure factors on commodities. There's the dollar, there's the innovation and exploitation in innovation that is going to just make OPEC redundant.
How do you interpret the long bonds' inability to sustain above 2%?
Well, I do appreciate, Sean, you going for the macro, because to me, that's been one of my major indicators this year. It's when the consensus kind of reverts and ignores the trend. So the consensus on the planet, which was a major, was that all bond yields are going to go up. So I started in this business in the trading pits in the 80s, trading long bonds at the Chicago Board of Trade. So it's still in my blood. And that long bond's inability to bump up above that 2% level to me is telling us that this is it's not a problem, but it's just expect more of the same. Deflationary trends, bond yields to continue to decline, and all we need is a little trigger. Friday was a little trigger to make those yields plunge back to trend. So here's a story I have to tell you. In the 90s, when I started trading JGBs, everybody said yields are going to go up. I'm short. I'm happy. Poof, that trade got flushed out. And then I heard the same thing in Europe. I didn't trade European bonds as much, but all those yields went negative. What stops the U.S. from going negative? I'll tell you one thing that's going to make U.S. yields go negative. To me, it's one little stock bear market. Say you drop 20% and stay down for a year. Stuff that used to happen.
Normal.
And it's not, well, that's normal, Sean. But what's abnormal is these rapidly advancing price, just unstoppable price changes. And that's kind of just revert a little bit. To me, when you see that, and then there should be some kind of workout. But for me, that's what I see. Crude oil's a good indicator. Soybeans a good indicator that, good luck with the inflation thing, because yes, I see we'll work out the bottlenecks. All these profits for energy companies, that means supply is coming. So
when we look at that point, let's look at the OPEC side of this now. This crash came at a point in which OPEC Plus was trying to digest how to proceed or react to the SPR release. Firstly, what did you think about the SPR release before this crash came on Friday? The market seemed to sort of spit out the hook, no big deal.
Well, it's completely unnecessary from a macroeconomic standpoint. From a political standpoint, check one off for Mr. Biden. He could say, hey, I'm a good trader too. I sold it at 80 and it's 70. So good for him. And it's politically get that. But I look at it as, hey, as a trader, he's selling good levels. Trump bought good levels. And
on that point, the inflation issue, putting aside the supply-demand balance in the market, but simply the inflation challenge that is presenting to the Biden administration means this is getting pretty red-hot political.
Oh, absolutely. And his midterms are coming up. By this time next year, just with normal organic trends I see in markets, I fully expect all these inflation trends to be reverting lower, most notably from commodities. Here's a good example of how that happened. In 1980, the Bloomberg Commodity Index peaked. It took till 2003 to break above that level. We're in a similar situation, might be worse. The Bloomberg Commodity Index just made a new high a few months ago. It might take another 10, 20 years to sustain above that level. So how you measure inflation is from that level. 12 months from now, it's going to be a very high bar. So I look at it as more deflationary. And what Biden needs that expanding economy to get elected, which means a higher stock market too. How he does that, good luck. But from an OPEC standpoint, to me, Sean, I'd like to see how it's not lose-lose. If they keep prices high, U.S. supply continues. If they keep them low, it's happening with technology anyhow.
Well, they had this the kind of uncomfortable situation last week of having to deal with this SPR release, but then were kind of let off the hook by the market, seemed to let it go. But then the big crash came, and the uncertainty on the COVID side, demand looking wobbly. And so the early part of this week, they suspend their meetings. They're in a bit of a quandary. What do you think they will do, should do?
I just wish them luck. I think they should focus on the trend. Is how many 10 years ago they were over 30% global production. Now they're 20%. Demand is flat. Supply is picking up in most of the rest of the world, working better and diversifying your portfolios. Now oil will be here for probably in my lifetime, most of our lifetimes, but it's just not the way it used to be. I drive an EV for a reason. Just look at their major customer 10 years ago was the U.S. Poof, gone. China maybe, but China's going EV fast. Why? Because they can't breathe. We've been there. I mean, I just remember the air's horrible. So good luck and diversify.
On that point, I mean, if OPEC decide to, suspend their increase this week, i.e. not proceed with adding more supply to the market, would you expect a further upward motion back to the 80s?
Sure, in the short term, but I think the politicians in this country will take to that as much as possible, bashing OPEC, bashing China. Remember, I was in the 70s. We remember that OPEC was kind of the enemy then when they kind of...
Nobody loses votes from bashing OPEC.
But exactly, that'll transition, I think, into bashing OPEC, and which gets to votes, and it's all that matters right now. This is political season. We're getting to 2022 is on the handle in almost 30 days, and and we have an election in November, so it's
but on that political side of things, how does Biden get around the sort of contradiction of calling on OPEC to add supply, but yet not sort of creating a facilitated, not facilitating domestic production, but sort of putting hurdles in front of it? That seems like an unsustainable contradiction.
I'm glad you pointed that, Sean. I was disappointed he went that route, because I think the more positive forward, best leadership route is to focus on, hey, U.S. is energy independent because we did the right things. We harnessed this technology, which is focused on U.S. supply and U.S. domestic, and not worry about OPEC. Let them handle the rest of the world's supply. U.S. doesn't need them anymore. So I look at him as focus on U.S. innovation, U.S. jobs, U.S. production in North America too, but maybe he'll take my advice there.
In that, going into the new year with the sort of, obviously we're dealing this year coming to the end of 2021 with this, the whole sort of market recovery, the COVID vaccination recovery, but we go from that into 2022 red hot politics. If you were doing a reflection on 2021, what do you think, what is your sort of big moments to think about going to the end of the year, and what you might be sort of watching out for into the new year?
Well, I really appreciate the question. I think the history is going to look at 2021 as a big bounce in prices, and the hangover really kicking in 2022. Stock market just cannot sustain these kind of appreciation for that long. I pointed out the agriculture index was up 3 years in a row. It's never been up 4 years in a row. It's just that trickling down. We're back to normal. Now, COVID is going to be with us forever. This pandemic, international travel, and I look at that as kind of the spark that I've seen in already way extended prices of virtually all assets. And the key thing I see going forward is what you see in commodities is back to the old school days that well. Anybody senior commodities know the best performing commodity over history from investor is gold. You don't have to roll the futures, you don't have to store it, but gold is being replaced by Bitcoin. So I look at what we're going to see next year from a commodity standpoint. Bitcoin and gold continue to appreciate, with Ethereum in there too, and commodities going back to that downward trajectory, which has been in for at least 10 years.
Is the American government, is the Fed going to have to choose between kind of Main Street and Wall Street, if you like, between inflation and stock market elevation?
Well, they're doing that now, but I think the Fed's hand will be tied, Sean, once we see a little bit of reversion in the stock market, and the Fed's going that way by tapering and talking about tightening. All you need is that stock market to stop performing, and all Fed tightens off the table. We go back to deflationary type trends. I'm worried about that scenario, but history says you cannot have this type of appreciation forever. And what are we, 24% this year? Okay, I think the market, that's like the third or fourth year in a row we've averaged 25% in the stock market. Just imagine if we have down 5%. Means nothing, but to me, that's where you go back to that trend where Fed stays at zero, rates, yields plunge. I think some of the best investments I've been saying is gold, Bitcoin, and long bonds.
Well, the ability of the Fed to sort of get rates off the floor seems to be some really heavy lifting, and any bit of wind that comes to go in its sails seems to get knocked out. I mean, Friday is many different things, but one of the things that it does ultimately is any little bit of wind that was coming into the Fed sails is at least potentially deflated and not removed. I think that's really one to watch. Listen, Mike McGlone, as always, great to get your insights. There's nobody as good as you on these questions. Thank you so much for checking in from Miami. Enjoy the sunshine. Afternoon sundowners on the beach, I hope. All the best, Mike. Thank you for being on Halftime Talk this week.
Thanks for having me, Sean.